In this video, we're going to talk about the relationship between the financial statements. In this course, we're going to cover three financial statements. They are the income statement, the statement of owner's equity, and the balance sheet. Now, the financial statements are prepared in a certain order. And the reason that they're prepared in that order is because information is shared among the statements. So the first statement that is prepared is the income statement. So we have a company here named Bellwether Company. Here's their income statement for the year ended December 31st. So financial statements are always start with a heading, and the heading contains the name of the company, the name of the statement, and the date. For an income statement, it's prepared for a period of time, so we state here it's for the year ended December 31st, 2021. If it had been a month, we would put for the month of March or December and the date, or a quarter. All right, so every statement has to have a heading, and that's a part of what's called good form. Next, we move to the revenue section. So there is a heading and it's called revenue, and under that heading we list out all the revenue accounts. So Bellwether Company only has one revenue account and it's called service revenue. Now an income statement will have two columns. This is the subtotal column and this is the total column. So had we had more than one revenue account, we would have put the numbers in the subtotal column and then summed them together to the total column. But because we only have one revenue account, the dollar amount goes out to the total column. Now we have expenses, so that's our heading, expenses, and we have 4 expense accounts. So since we have more than one, they're going to be listed in the subtotal column. So the first account is called wages expense, and it is $1,925. Now, one of the rules of good form, right? So good form is how we need to prepare our statements. One of the rules says we always have a dollar sign for the first number in each column. We had one over here, and here is the first number in the column. We have that dollar sign. So wages is $1,925. Then we have our depreciation, our rent, and our supplies. Now we're going to sum them together and put the total in the total column. So we put a line underneath it to indicate that we will be summing these numbers. Here's my total, $3,475. And we will be subtracting that from our revenue. So we indicate that with another line. So we take our $15,600, subtract out the total of our expenses, which is $3,475, and we have net income of $12,125. The total on our statement always gets a dollar sign and a double underline. That means it is a final number. Okay, so our net income is $12,125. Now, if you remember earlier, I said that information is shared among the statements. Well, the net income is needed to go into the statement of owner's equity. That's why we prepare the income statement first. So the income statement's prepared first so we can calculate out that net income. The net income goes from here to our next statement, and that is how the financial statements are interrelated. So now we have Bellwether Company Statement of Owner's Equity for the year ended December 31st, 2021. It has a heading just like the income statement. Okay, so the format for the owner's equity statement is we start with our owner's capital at the beginning of the year. So here we have owner's capital January 1, 2021. Then we have additions. Now you could have potentially 2 additions to our owner's equity. That would be net income and owner's contributions. Bellwether only has one of them. They only have the net income, and as you can see, my arrow indicates that it's coming from the income statement and going into the statement of owner's equity. So here's my $12,125 of net income. We don't have any owner's contributions, so then I'm just going to go ahead and add these two together, my beginning balance and my net income, and I get a subtotal, 15,980. We have that line indicating that we sum those two numbers together. Now remember, all statements are prepared in good form, and there is my dollar sign for the first number in the column. Okay, so next we have less. So these are all the reductions to the owner's equity account. There are two amounts that can reduce owner's equity. They are the owner's drawings, right? When the owner takes money out of the business, that's going to reduce the owner's equity, and a net loss. Now in this particular case, we have net income, and you won't have net income and net loss in the same fiscal period. So we only have one reduction, and it's owner's drawings. The owner withdrew $2,500 from the business. We have a line to indicate we're going to do some math. We take 15,980, subtract out the 2,500, and we get owner's capital on December 31st, 2021 of 13,480. That's the ending number in our statement, so we get a dollar sign and a double underline. This is also the number that goes from the owner's equity statement to our next statement. The next statement that's prepared is the balance sheet, and we need that balance in the owner's capital for our balance sheet. That's why it's prepared third. So the income statement's prepared first, the statement of owner's equity is prepared second, and the balance sheet is prepared third. Once again, the balance sheet has a heading, the name of the company, Bellwether Company, the name of the statement, the balance sheet, and this one says December 31st, 2021. The balance sheet is prepared as of a specific date. Okay, so the balance sheet is prepared as of a specific date, unlike the owner's equity statement and the income statement that are prepared for a period of time. Now these end on December 31st, and so the balance sheet will always be prepared on the date that is the last date of this period. So this is for the year ending December 31st, and this will indicate December 31st, 2021. And that is the heading for the balance sheet. Next, we have our heading, Assets, and we list out our assets. And as you can see, the first number in the column gets a dollar sign. And the assets are listed in the order of liquidity. So cash is our most liquid asset, so it comes first. So we have our cash, $2,100. Then we have accounts receivable, prepaid expenses, long-term investments, property, plant, and equipment, accumulated depreciation. And we add all those together and we get total assets of $18,567. We end it with a line, a dollar sign, and a double underline to indicate that this is the total assets. Next, we move on to liabilities and owner's equity, and we list out the three liabilities that we have: accounts payable, mortgage payable, notes payable. We start with a dollar sign. We have our line to indicate there's a subtotal, and it's $5,087. That's our total liabilities. Next, we have our heading, owner's equity. Then we have our owner's capital account. Remember, that's coming from our statement of owner's equity. It comes around 13,480. And then we have our total liabilities and owner's equity, $18,567. Now, this is a balance sheet, so it's really important that the total assets equals the total liabilities plus the owner's equity. So we have 18,567, 18,567. If those did not balance, it would not be in balance and we couldn't call it a balance sheet. So let's just kind of recap. The financial statements are prepared in a certain order and information is shared among the statements. First, the income statement is prepared so we can calculate out the net income or the net loss. Second, we prepare the statement of owner's equity so we can calculate out the owner's capital using the net income or net loss prepared in the income statement. And lastly, we prepare the balance sheet using the ending owner's capital balance from the statement of owner's equity. And remember to use good form. Sometimes it's called proper form, but that means that we have a heading. The first number in every column gets a $sign. We put a line under a total or the ending amount in our statement. The last amount in our statement gets a $sign and a double underline. So let's go ahead and do an exercise. So here we have the Roosevelt Company. We have their trial balance for the year ended December 31st, 2021. And we're going to use this and we are going to prepare their financial statements. Okay, so let's begin with the income statement. And we need to do a heading. So we'll do Roosevelt Incorporated is the name of the company, and the income statement is the name of the report, and this is for the year ended December 31st, 2021. Okay, so we're going to highlight each number as we use it. This is our trial balance, so it's all of our accounts, and the ending balance is as of December 31st, 2021. So we have to use every one of these accounts. I'll highlight them to make sure we include them someplace. So we prepare our income statement first, so that means we start with revenue. So here is our service revenue, $15,600. So we'll put that here, 15,600. And that's our only revenue account, so it goes out into the total column and we get a $sign. Next, we have our 4 expenses, and they are wages, depreciation, rent, and supplies. I'm going to highlight them. So here's our wages. That comes first. So it's $1,525. Next, we have our depreciation, which is $625. We have our rent expense, $600. And we have our supplies expense, $725. There is a line under that indicating that we're going to do a total, and we have $3,475 as our total expenses. We get a line under that. And now we have to calculate our net income. Our net income is the service revenue minus our total expenses, and that gives us $12,125. Since that is our total, we need a double underline. You can't see that there, but it's there. Let me see if I can make that column. There we go. There's a double underline there. Sometimes it's hard to do tables in Word, so it's a little choppy. All right, so that's our income statement. All right, from our income statement, we take our net income and it'll go into the statement of owner's equity. But we'll do that in a minute. First, let's do our heading. Roosevelt. I cannot spell. Statement of owner's equity, and it is for the year ended December 31, 2021. Now, the income statement and the statement of owner's equity are always for the same period of time. So let's begin with our owner's capital. It's as of the beginning of the year, so it's 1/1/2021. And we need our $sign. It's $3,855. Let's bring down our net income, which is $12,125. And we will do a subtotal, $15,980. Then we have, I'm sorry, and our owner's capital is right here. Got cruising along and I forgot to stop and show you where the numbers were coming from. So that's our beginning capital. We have our net income from this statement, and then we have our subtotal. Now we have our drawings. We have to come up here and we look, and the owner's drawings are $2,500. Okay, we have a line underneath to indicate we are going to do a subtotal, and that is $13,480. And this is end of the fiscal period, so it's 12/31/2021. Our owner's capital balance then will go from the statement of owner's equity to our balance sheet, and we'll bring that over when we get to it. So let's go ahead and do our heading on our balance sheet. We're going to prepare our third statement. So we have to put the name of the company in. So it's Roosevelt Company, and this is December 31st. So remember that the balance sheet is as of a specific date, and it is the last day of the period that is for the income statement and the statement of owner's equity. All right, so let's go ahead. So our first asset is cash. So here we go. We're going to highlight cash, and it's $2,100. And we need a dollar sign, right? Because it's the first number in a column. Next is accounts receivable, and that's $1,696. Next is prepaid expenses, $1,180. And next is our long-term investments, $2,190. And our next asset is property, plant, and equipment, which is $15,056. So property, plant, and equipment is the things we use to generate our revenue. Could be if we were Walmart and we were storing our milk, it would be refrigeration units. It could be the shelving units. It could be furniture, whatever we need to generate revenue. All right, so we have our property, plant, and equipment, and we have some accumulated depreciation on that equipment. So that is that's a reduction. So that's $3,655, and it says less right there. And our total assets are $18,567. And there is a double underline underneath them, and there is a dollar sign. All right, so let's keep making progress. So now we're on the liabilities and owner's equity section. So our first liability is $1,000 for our accounts payable. So I'll highlight that. Next is our mortgage payable, $1,443. Next is our notes payable for $2,644. Okay, and that's all of the accounts on our trial balance that have been used. So now I need to subtotal all of my liabilities, and I get $5,087. Okay, next we have our owner's capital, and our owner's capital comes from our owner's equity statement, $13,480. And when I add those together, I get $18,567. So I added $5,087 to my $13,480. I get $18,567. My total assets equals my total liabilities, and my balance sheet balances. And that is exactly what we're looking for. That is how to prepare financial statements. I hope that makes sense.